This is the World Financial Report podcast. My name is Randy Marshall. Joining us is our financial and diamond expert, Harold Siegel. We're taping on April 26th, 2018. Our time is 8:05 Mountain, and we will talk about Toronto here momentarily. Running down the market numbers, and we should mention first, connect with Harold at rarecoloreddiamonds.com. rarecoloreddiamonds.com. 1-800-432-1022. The market numbers, US dollar at 91.02, up a bit. Canadian dollar 77.91, 128. Gold 13.2220. Silver 16.51. Continue to trade within a range. Gold-silver ratio was 78 last week, 80 this week. Platinum 9.13. Palladium 9.84. WTI 68.35, Brent 74.68, Nat Gas 2.79, Bitcoin in the United States priced at 88.41, and Canadian 11,354. Starting the day, the Dow at 24,156, S&P 2650, the Nasdaq 7,003, TSX 15,509. And connect with Harold at rarecoloreddiamonds.com or 1-800-432-1022 when it comes to investing in hard assets. Now, Harold is a Canadian who lives in the United States, goes between Florida and Colorado. And Harold is a Canadian who grew up in the Toronto area. Obviously, we're all very saddened. First, we had the Humboldt tragedy, and now a Toronto man charged with 10 counts of first-degree murder and 13 of attempted murder after a van struck dozens of pedestrians on a busy sidewalk Monday afternoon in the worst mass attack in Canada in almost 3 decades. And I know that here in Western Canada, we're very upset about it. We obviously send our thoughts and prayers to everyone in Eastern Canada. But what a terrible, terrible situation.
I'm still absolutely in shock over it. What is this world coming to, Randy? It's just horrible that now, I don't know, they haven't said whether it's a terrorist-related attack or why this guy did this. But, I mean, just the description of what people were saying that he did, he was just driving on the sidewalk, just hitting every single person that he could. I just don't understand that. You know, the other thing, since everyone knows I live in Parkland and the shooting was a couple months ago, do you realize that within the last couple months there have been 20 arrests of kids that were posting online that they were going to shoot up their schools? So I just don't understand what's happening with this generation and where this thinking is coming, but that's horrible. I mean, all of us are in tremendous sorrow over what happened in Toronto. Don't know anybody that was affected by it, but again, just the fact that it happened in such an amazing city is just despicable, just absolutely despicable. Don't know what this world is coming to. Anyways, the markets this week were volatile as far as the metals go. And again, this week was a perfect example of the relationship between the U.S. dollar and gold. When the U.S. dollar is strong, gold is weak, and vice versa. So we've always said that. We've always said that there was a direct relationship between gold and the U.S. dollar. However, recently, the U.S. dollar has been lethargic. So basically, even though the U.S. has been raising interest rates and the U.S. dollar should have strengthened, it's obvious that Trump wanted a weaker dollar for export purposes. So we always felt that they've been manipulating the currency market. This week, for whatever reason, the U.S. dollar went from 89 to 91, and the price of gold went from 1360 in that area all the way down to heavy support of 1320. So we saw about a $35 to $40 drop in the price of gold this week, and that was strictly to do with the fact that the U.S. dollar rallied. Now, is that something that is sustainable? Is all of a sudden Trump saying that we want a strong dollar? Now, I heard nothing to support that whatsoever. So again, what we could be seeing at this particular point is just a rally in the U.S. dollar, and then by next week, again, we could see the U.S. dollar come back down to 89 cents and the gold market go back up to the 1350, 1360 level. Now, also what is a strong supporter of gold is the fact that the bond market, we feel, is in trouble. Not only is the bond market at a dangerous level, but because of the sanctions and the trade war that we're going to have with China, if that does go through, that is definitely going to affect the bond market because, number one, China is not going to buy our bonds, and number two, China may decide to sell out of the bond market, which would mean that the U.S. would either have to sell their bonds, which is basically selling our debt. So either they'd have to sell it to another country, and there's not a lot of countries that are buying the U.S. debt right now, or buy it themselves, which is ridiculous, but it has happened in the past. So at this particular point in the U.S., if the bond market is going to go in the wrong direction, and another reason why bonds could be in trouble is because of potential inflation. If you're watching the price of rental homes, of gas prices going higher, and of food prices going higher, we're now starting to see signs of inflation. Now, as inflation starts to come, that's when they're going to raise interest rates again. Now, it's possible that we could see some interest rate hikes in Canada because Canada is going to experience inflation the same as the U.S. will. So if that is an indication, and the bond market is about to fall because it's at a very dangerous level and we've got these issues with China, we could see a massive rally in gold and silver and a massive decline in bonds and in stocks. In fact, there's some feelings in the market right now that the Dow has got the potential of a 50% retracement. That's very similar to what we saw back in 2008 when quantitative easing happened and all the bailouts happened and everything like that. When all of a sudden the Dow back in 2008 went from 14,000 down to 6,500 when it dropped 50%, that's a massive drop. The amount of loss in the stock market was massive. People got wiped out. Now, one other thing that we should always know about the stock market, and this is extremely important, is that there's two sides to the market. There's buyers and then there's sellers. So the fact is that when a market is going up, the buyers are making money. But when the markets are going down, the buyers are losing money because their positions are falling in price. But who makes that money? Who all of a sudden goes so heavily short the stock market in 2008 and made all that money when the Dow dropped from 14,000 to 6,500? Somebody made a fortune, because for every winner there's a loser, and if everybody was losing in the stock market, somebody was making that money. Somebody was so heavily short the Dow at that time that knew that this was going to happen that made all the money. Now, this is where the Bilderberg Group and all these conspiracy theories really come into line, because the fact is that if trillions and trillions of dollars were lost in the market, it means that trillions and trillions of dollars were made in the market by a very small amount of people. So the bottom line is that when the Dow dropped, again, from 14,000 to 6,500, the people that were long the market or bullish on the market lost almost everything. And it was only the people that had the guts to stay in the market 10 years later made back their money, and now they're in profit. But we haven't seen a sizable correction in the Dow since 2008 and 9, and it's now 2018-19. So the fact is, it's been 10 years. We're due for it. And the fact is, there's enough happening geopolitically in the marketplace, and with the tremendous debt that the world is in, especially the United States, and if we're going to have issues with China and Russia, this is a recipe for the Dow taking another one of its famous plummets that catches everybody by surprise and wipes out all these gains that people have seen over the last 10 years. So if that's you, if you're sitting in that market and you're sitting there saying, you know, things are great, we're going to make a ton of money, everything is phenomenal, you're looking through rose-colored glasses, because every market corrects from time to time, and the situations that are present in the market right now are so frightening and so volatile that, again, any situation can kick off a massive sell-off in the Dow. Don't forget, the hedge funds And the major traders that trade in these markets have stop losses in the market. So that means that if the Dow is trading at 25,000 and they feel that the support in the market is at 24,000, and if it was going to break below 24,000, the market was going to fall substantially, what you will find is that there's sell orders in the market just below that support level or that support level. And if the market breaks that support level, all these orders get filled. And all of a sudden, the market starts to, like a domino effect, plummet. And it's almost unstoppable. It's like a freight train on the loose. And that's what can happen. And that what looks like could happen again within the foreseeable near future. So again, if that's you, with all of your money sitting in paper and the stock market, either put stop losses in the market. Not that stop losses will protect you against losses, because what happens in a stop loss is that if you put a stop loss in on a position in gold or silver or stocks or a particular stock or anything, and that number gets hit, all of a sudden the next trade is where you get sold out at. And that next trade could be substantially lower than where you placed your bid. So again, you've got to have some type of protection. Either know how to trade the markets and know how to utilize stops in the marketplace using resistance and support levels. And if you don't know that, which 99% of the people that trade don't, you better have something that's going to offset the potential of losing all your assets. Now, again, if you're 20 or 30 years old, or even in your 40s, you may be able to sustain another massive drop in the Dow. But the fact is, if you're in your 60s or 70s, like a lot of us are, we can't. We're not going to lose all of our money again and then sit back another 10 years and hope that that market's going to come back enough for us to break even. Personally, I don't trade in stocks. It's a manipulated market, and again, those type of markets concern me. A market is supposed to trade on its own volition. You have participants in the market, buyers and sellers. Buyers think the market's going to go higher. Sellers think the market's going to go lower. So you've got two different forces battling it out in the market. And each one, if they guessed correctly or did their homework correctly, deserve to make their reward, their profit on picking the right trade. But when you pick the right trade and the market goes down anyways, then you know that you're not playing on a fair playing field. And unfortunately, as the markets get more volatile and get into a more dangerous structure, these type of manipulations happen. We've seen it happen many times. I pointed out to our listeners many times back in 2011 when the gold market, which was on its way to 2,000, it hit 1920, all of a sudden plummeted down to 1,050. There was nothing in the market that made gold drop to $1,050 from 1900. That was a 900-point drop that happened just because the government didn't want gold at $2,000. So they raised the margin requirements for 5 days in a row and destroyed the market. There was nothing in the market at that time that would have caused gold to go from 1900 to 1,050. So that's why I don't trade the paper markets. If I am trading an asset, it's going to be a live asset. It's going to be something that I hold in my hand, like physical gold and physical silver and diamonds and art and classic cars and stamps and those type of things. Not a piece of paper. When we sat back in 2008 and 9 and saw Citibank and Bank of America and all the brokerage firms going out of business, and McDonald's couldn't make payroll, and General Motors went bankrupt, and Chrysler was on the verge of bankruptcy, and the major insurance companies were on the verge of bankruptcy. And then the government had to step in and print trillions of dollars in order to bail out these corporations. I mean, if that happens again at this particular time, do you realize that the U.S. is bankrupt? They're pretty well bankrupt now. They owe way more money than they bring in. And the fact is that there's not enough money being paid out, being brought in tax money to make up the losses from all the debt that the U.S. is holding. And then by raising interest rates, they're making this debt even more expensive because higher interest rates means you're paying more interest. So it's a very scary situation, Randy. Again, I wouldn't be complacent at this particular time and sit back and just think that everything is okay. Everything isn't okay. When the U.S. is bullying the two biggest trade countries in the world, Russia and China, and making enemies of Iran and everybody again now, and even making enemies of Canada, because Trump has just been the biggest bully, and he's just writing buckshot over everybody. I mean, he doesn't care who he hurts, and this is going to blow up in the U.S.'s face. So, again, at this particular point, if you're sitting in stocks in the U.S., watch it. It's a very dangerous market right now. Gold is on the lower end of its range, and I do believe it'll hold. I don't think that the U.S. dollar is going to strengthen enough to hurt the gold market at this point. So as it dips, now is a good time to buy it.
If you'd like to learn about investing in gold, speak with Harold, 1-800-432-1022. 1-800-432-1022. His website, and it's like going to a museum online with the world's finest investments and their beautiful rare-colored diamonds. Go to rarecoloreddiamonds.com or speak with Harold personally and privately, 1-800-432-1022. Get our free weekly newsletter, the companion to the podcast. And in our free weekly newsletter, one of the nuggets, 75% of the ultra-rich forecast a U.S. recession in the next 2 years. Of those expecting an economic downturn in the United States, a fifth of respondents, 21%, believe it will begin in 2019, and 50% expect the next recession to start in 2020. That's right, about 2 years away. The ominous predictions may come as a surprise to some, seeing the U.S. is enjoying strong economic growth, robust corporate earnings, and its lowest unemployment in 17 years. The IMF recently upped its U.S. growth forecast for 2018 to 2.9%. But the ultra-rich very concerned about the economy. And one of the things that we had touched on, and Harold did mention it with his commentary, we had said quite some time ago, watch the 10-year. The 10-year yield breached 3%. And that really rocked the markets during the week. And that was for the first time since January 2014, in a signal that higher interest rates are ahead in the world's biggest bond market amid an onslaught of supply and Federal Reserve intent on boosting interest rates. And they're talking about raising rates maybe 3 times more this year in the United States. The yield, the benchmark for everything from U.S. mortgages to dollar bonds in developing nations, climbed as high as a little over 3% on Tuesday before retreating, but it has been up and around there all week. And when you get to a point where the 10-year and other bonds are above 3%, and if they raise rates, they become very competitive alternatives to the stock market. And in fact, even the 2-year yield is at 2008 highs. And some are saying that's scarier than the 3% the 10-year is showing us. And people are very concerned about the stock market. We have a chart in our free weekly newsletter. It's not 3% yields that threaten stocks going by a 40-year pattern. A 2-week bounce in equity seems to be losing steam as the 10-year Treasury approaches the much-feared 3%, which it hit. The worry is premature, according to Tom Lee. He's the co-founder of Fund Strata Global Advisors, LLC. Well, almost every major peak in bond yield since 1980 has coincided with declines in stocks. The trend line that plots the high points to a danger zone is 3.25% to 3.75%. And obviously, that's something that if the United States raises interest rates 3 times this year, maybe 4, you could very easily find yourself in. So now is a time for caution on the stock market. It should be noted that in Canada, and this is something that we follow very closely, the United States raising rates, Canada not raising rates. And the Bank of Canada Governor Pelose lays down some markers for cautious rate hikes in Canada. He's unapologetic about his cautious approach to raising interest rate, and he faces constant criticism for stoking debt accumulation with cheap credit. His reluctance to match higher U.S. rates has fueled a drop in the currency. And now there's a challenge. Canada's inflation is picking up pace. Well, at the same time, the jobless rate is at the lowest level in 4 decades, and the expansion is running up against capacity. So even Pelosi is willing to err on the side of nurturing an economy that's feeling the effects of the last global credit crisis. Now, Harold, that is a very interesting scenario. We will have to watch in the days, weeks, and months ahead. The United States continues to raise rates. Canada doesn't. That means the Canadian dollar, no doubt, is going to take a hit going forward.
There is no doubt about that. Now, again, we've seen this happen many, many times. And the fact is that Canada is used to a weaker dollar. And again, because Canada exports, that it's a good thing in that sense. However, a weaker dollar for travel or for other situations is not good for Canadians. A stronger dollar for Canadians when they travel is a much more beneficial situation. So, again, the currency markets are amongst the most important markets there is. And if you're not familiar with how they work, it could be detrimental to things that you do, travel, business outside of the country that you're working in, and that type of thing. So, again, I think it's a good thing at this particular point that Canada is not raising interest rates, because Canada is not really in competition with the United States. Canada needs to keep their interest rates lower till they get the real estate market back on track, and to help the citizens because Canada's got its largest debt levels amongst consumers that I think that they've ever had. And obviously by raising interest rates, that is detrimental to the consumer because he's going to pay out more interest. So his paycheck doesn't go as far. So again, I think lower interest rates in Canada is not a terrible thing. It's only going to hurt Canadians that travel overseas or go to the States, because there's about a 25% difference between the Canadian and the American dollar at this time.
We are strong believers in hard assets. And if you'd like to learn more, speak with Harold, 1-800-432-1022. His website, rarecoloreddiamonds.com. In the past couple of weeks, we've had auction results for you. We'll be happy to send them out to you. The next set of auctions coming up in Geneva in the middle of May. Now, Christie's is going to auction a 20-carat yellow diamond ring, and it is estimated to sell between $3.9 million to $4.7 million. Now, you have Sotheby's offering 2 D-flawless diamonds, and they will be offered in Geneva, along with Sotheby's offering that 300-year-old blue diamond. Now, there was an auction in New York City. We did talk about Sotheby's. They had a record breaker for a blue diamond. It was a 3.47 carat fancy intense blue ring sold for $6.6 million at Sotheby's last week, setting a new sales record for a stone of its grade with a $1.92 million price per carat. But there was another auction, and I found this information. Harold, I think it's so interesting, the backstory on this diamond, because it is so interesting. So the blue diamond that sold for the record price has a very unlikely backstory. According to Robin Wright, senior specialist with the jewelry department at Sotheby's, the ring was acquired shortly after World War II by a Pan Am pilot who gave it to the woman he would marry, who was a Pan Am stewardess. Now, although the pilot died shortly after, his wife held on to the ring for many decades, wearing it at a time before colored diamonds were extremely sought after. There was no market for them back then, Wright said. They would have been priced considerably less. The stone even bears a chip from when it was briefly dropped in a garbage disposal in the 1970s. Now, after the owner died in 1990, the ring passed on to her daughter, who got it appraised in 2006 by a local jeweler in the Midwest. He estimated that it was worth about $150,000, The family was very pleased with the auction result. Wright says, "It's a real American story. Another fancy, intense blue diamond fetched nearly as high a price at Christie's auction house on Tuesday. The 3.09 carat ring sold for $5.3 million with a price of $1.74 million per carat. The sale also surpassed the auction house's estimate, which expected to bring in $2 to $3 million. And we had mentioned that, but that 3.47 carat fancy intense blue diamond that was a record breaker that we touched on the last podcast. I love the backstory, Harold, and we've heard that backstory many times before, where people back in the 40s and 50s and even the 70s went out, picked up colored diamonds, held onto them for the long term, and they did very well at auction with them here in the last 10 years.
You know, that's so exciting to hear. And there'll be a lot more of these type of stories, because the fact is that rare colored diamonds are more visible today than they've ever been. As you mentioned, in that backstory, is that they didn't know anything about blue diamonds. And back at that particular point, he just bought it because I'm sure it just looked pretty. And I'm sure the price was decent. But to think what he would have bought that diamond for if it was appraised in way back then, for such a low price of around $150,000, and to see it go in the multi-millions, that happens with those type of assets. And the better the diamond you buy over the longer term, the more and more expensive that diamond is going to become. And if you don't need the money yourself, you keep it in the family and you turn it over to the kids and the grandkids. And that's where these assets really start to take on a life of their own. Diamonds have never been a short-term investment. The only thing shorter term about the diamond market at this point is the Argyle pink diamonds. Because in 2020, the Argyle mine that produces 95% of the pink diamonds in the world is going to close. There won't be any more pink diamonds. We anticipate that the prices are going to go substantially higher. But that's not a necessarily a long-term investment, because anybody buying a diamond today in Argyle pink only has to wait maybe a couple of years for the mine to close. Give it a couple of years after that for all the diamonds to be gone. And you're talking about something that most people will never, ever own again. And the longer you hold on to an asset like that, the more and more and more valuable that diamond will become. So it's an exciting scenario to see what's happening in the diamond market, very similar to what happened in art and classic cars and those type of things. People like to own assets that are beautiful, that they can show off, that they can wear, that they could drive, that they could, have pride of ownership. To show a stock certificate for Apple is not as sexy as owning a beautiful pink or blue or yellow flawless diamond. So again, it's a great time to own these type of assets. And again, these are assets that could be sold in other currencies. If the US dollar is strong, we want to sell diamonds in US dollars. If the euro is a stronger currency, we would like to sell it in euros and can attend auctions or hold auctions in those particular areas. So again, where the majority of wealthy people at this particular point feel that there's a lot of risk in the stock market, people don't feel that way when they're buying gems. When they're putting it away for their future and for their kids' and grandkids' future. Most of all of my grandchildren own diamonds, not that they know it yet, but put away for their future. I've not bought any stocks or anything like that for their future, or will I? If I would have bought General Motors stock in 2008, that company went bankrupt. But you'll never see gold go bankrupt, and you'll never see a diamond go bankrupt. So I feel much more comfortable putting my money into a hard asset that I own and can hold on myself, as opposed to owning something paper that is manipulated.
Buy things, invest in things that governments cannot print. It's that simple. They are printing money like crazy, but you cannot print a blue diamond. You cannot print a Picasso. There are the originals, and that's what you want. But next month is going to be very interesting in Geneva on May the 15th and 16th. So Christie's with that big yellow diamond, 20.49 carats.
Now, Randy, on that yellow diamond, are they saying that it's a vivid yellow diamond?
Let's take a quick peek here. They actually do not give whether it's vivid. Oh, actually it is. No, it's a fancy vivid yellow diamond ring. So they're saying fancy vivid yellow. Another notable is an 8.52 carat fancy intense purplish pink diamond solitaire ring. The estimate on it, $3.6 million to $5.2 million. So we're going to have, in the middle of the month of May, one obviously huge auction with Christie's and another with Sotheby's. So we have the yellow diamond ring, we have the fancy intense purplish pink diamond, we have the two D flawless diamonds, and they're weighing in at about 50 carats each. And oh, by the way, we cannot forget, this is the one that we talked about a number of weeks ago that got me so excited. It's the 300-year-old blue diamond. And early indications are, and this is Geneva Magnificent Jewels and Noble Jewels Sale, May the 15th, is going to be a sparkling event filled with statement diamonds, according to Sotheby's. First up is a 6.16 blue diamond, 300 years of royal history, the Farnese Blue. Sotheby's is calling it one of the most historic diamonds ever offered for public sale. It's also the first time in the diamond's 300-year history that it's appearing in a public market. Think of that. 300 years. And it's being revealed for the first time to the public. The estimate on it, 3.7 to 5.3. I just don't see that happening. I think I'd be stunned if it doesn't go for much higher, $10 million. Now, the pear-shaped blue diamond was given to Elizabeth Farnese, Queen of Spain, in 1715, a descendant of Pope Paul III, following her 1714 wedding to King Philip V of Spain, grandson of Louis XV, King of France. It has since passed through royal families of Spain, France, Italy, and Austria. The auction house said, a witness to 300 years of European history, from the aftermath of the Spanish Succession War to the fall of the Habsburg Empire. Throughout this time, it was secretly kept in a royal casket. Think about that. Outside of close relatives and family jewelers, no one knew of its existence. And this is why, Harold, I get so excited about diamonds when you hear the backstory, whether it be the Pan Am pilot who got it for his fiance and then wife, or we hear the backstory on this Farnese Blue, 300 years old. Just so exciting. And they're saying 3.7 to 5.3 million, Harold. I just don't see it.
Okay, so it's obviously not an intense or a vivid. It's I guess, just a straight fancy blue?
That's what they're saying here, yes. But the provenance...
Do they give a clarity on it?
They don't here. I'd have to look it up.
I tend to agree with you, Randy. I think that once that hits the auction block with the history on that diamond, I think it's going to sell for a fortune. What a beautiful, beautiful opportunity is, and how exciting that diamond is actually going to be seen after all these years.
Connect with Harold to rarecoloreddiamonds.com. Rarecoloreddiamonds.com, 1-800-432-1022. Get our free weekly newsletter. And in our newsletter, there were wine auctions. And we have actually two stories about two different wine auctions that were very successful. Bruce Springsteen, the lyrics for his 1975 anthem, Born to Run, they were sold and being resold. In fact, they actually fetched $197,000 in 2013, and they think that it could go for as high as $300,000 at auction. So somebody's money is going to be running in the direction of a historic piece, the lyrics for Bruce Springsteen's Born to Run. And Harold, it just goes to show, whether it be art, cars, handbags, watches, rare colored diamonds in general. And then we dip into the wine market. We dip into the collectible market, like baseball cards, hockey cards, and then we have lyrics, memorabilia associated with great acts like the Beatles or the Rolling Stones or Bruce Springsteen, the Boss. And you can see that people are paying a price for it because it's, as Harold said earlier, somebody walks in your house and sees the lyrics to Born to Run, it's going to impress the heck out of them. There's no getting around it. And you can't do that with an Apple certificate on the wall. And if you're wearing a rare colored diamond, it speaks volumes. So Harold, now is a time for hard assets. And any closing thoughts as we wind up today's podcast?
Well, I agree with you 100%, Randy. The fact is that you need to diversify when you invest anyways, but now's a dangerous time. There's things happening in the market that you need to pay a lot of attention to. And again, if most of your money is sitting in paper, stocks, things like that right now, you need to understand the markets more, and you need to have some type of protection. We're strong advocates of alternative assets that aren't manipulated, assets that you can hold in your hand and enjoy and have fun with and pass down from generation to generation. So again, at this point, our hearts go out to everybody in Toronto that was affected by that horrible situation earlier in the week. I just can't believe that we're living in a world where people do this type of thing. And again, it was heartbreaking. It's my hometown. In actual fact, this is twice in the last couple months that we've been saddened by events. Living in Parkland, Florida, beautiful area in South Florida, where I've been for 25 years now. Lived 2 blocks away from the school where, 17 people were shot and killed, and now on the streets of Toronto. It's a horrible, horrible time, and we really need to get our act together. These are situations that should never, ever happen.
Parkland was a major, major tragedy. Obviously, somebody who had some serious psychological problems. And then we had the Humboldt tragedy, and that is still unfolding, and we will find out the cause of that at some point. And then we move on to Toronto, and this guy supposedly just could not, from what we can tell now, and we don't know it fully, but it's pure speculation. If you read his social media accounts, as the media did, he could not get a date. But that does not mean you drive down the street and kill a 90-year-old grandmother, or you kill a young woman working at an investment firm. And those are just a few of the people that have come out so far. But just imagine a woman in her 90s, a grandmother, dying at the end of her life that way. It's very, very sad. But
it
Harold,
certainly is, Randy.
Yes. We'll keep everybody on top of the situation with our next podcast. And Harold, thank you for your knowledge and another great podcast.
It's my pleasure, Andy. I wish everybody a wonderful weekend and a very profitable day.
And on a good note, we can mention that the GoFundMe page for Humboldt, the Broncos, it's shut down now, but they raised $15 million. So we'll end on a positive note. That's it.
Beautiful.
That's right. Yes. That's it. Another edition of the World Financial Report podcast with Harold Siegel and me, Randy Marshall. We will talk to you next week.